It's been a week where a lot has happened on markets, from geopolitical tensions to the inflation and interest rate narrative continuing to persist, and of course flow-on implications for the energy and commodity sectors and what that can mean for prices around the world. Today we're going to be unpacking a big week on markets, but more importantly on the broader macroeconomic scale. We're going to talk about all of the news and the different effects that these could have for markets moving forward. Of course, as we know, the broader macroeconomic space has been a very interesting one to start 2022. We came in on the back of a strong year in 2021, but many of the leading major indices around the world have entered correction territory, with the NASDAQ, the technology-based index over in the United States, actually entering into bear market territory at stages, going down from over 20% peak to trough in its move. As we can see here, the S&P 500 is down by around 9%. It's off its lows, but if we have a look at the chart here on the right, we can see it's currently on the shorter term timeframes making lower highs, and most importantly as well, it's trading below that significant 200-day moving average level. In terms of the VIX, we know that the VIX has been spiking over the past period. There's been a lot to watch on markets, and so the VIX is back above that 30 level, which has been quite an interesting one and a critical one over the past period. We'll look into this later on in the video. And so before we do discuss everything that's played out over this past week on markets and how the markets and the broader macroeconomic landscape have been evolving, I did think it was important to note that everything we discuss here really is a distant second and really an afterthought in comparison to what is playing out in Ukraine at the moment. Of course, it is a difficult situation, and thoughts, hearts, and really best wishes are going out to anyone and everyone who has been affected by that. So yes, we'll talk about the implications for the macroeconomic picture, but really it is just a secondary picture in comparison to the reality about what is playing out over there. And so then just having a think about the current context and how we're positioned. Markets are fearful. If we look here, we can see here that we're really edging towards extreme fear. We're at that 21 level on the fear and greed index. But what's most important about it is the trajectory for how we've got here. As we can see here, if you cast your mind back to 1 year ago in 2021, we're relatively neutral around that 52 level, but we've got progressively more and more fearful over this past month. 1 month ago, we were around 34, then 25 a week ago, and now 21. Of course, a lot of this is due to the fear surrounding what's playing out in Europe and the uncertainty about what could happen moving forward. But of course, there's a range of different inputs, as well as the broader economic sanctions that we're yet to see how they will unfold and affect the broader markets. But there are many inputs that are seeing supply shortages, and of course, these have the ability to be inflationary in nature and flow through to many corners of the broader macroeconomic landscape. We're talking about the energy sector, we're talking about the wheat and the grain sector, but there's many more as well, and we'll talk about all of these potential implications later on in the video. Then on the other side of that as well, the volatility index. Of course, we know the VIX is often looked at as a bit of an indication into the state of the market and the state of the current mindset of the market. As we just recently talked about, the VIX is above that 30 level now. There's been a few times that the VIX has raised above that 30 level, of course, over the past couple of years, most notably got as high as a 70 level back during the March lows in 2020. But before the March lows in 2020, we hadn't seen a 30 reading on the VIX since the back end of 2018. Of course, you'll remember that back in that period, the Federal Reserve had raised rates 4 times in 2018. But even further to that as well, there was broader geopolitical uncertainties playing out. It was a period that had somewhat similarities to the current time on markets. Markets had entered correction territory with the S&P 500 down by 15, almost 20% at its lowest troughs. And so it's interesting to see that we've reached 30 at the moment on the VIX. And so investors are watching, where does it head from here moving forward? Keen to know your thoughts on it all as well. It is an uncertain period with a lot of different narratives playing out. So let us know your thoughts, drop in a comment below, and let us know where you think markets will head moving forward, particularly with the upcoming FOMC meeting, not too far away, just a couple of weeks into March. And so then to begin with a weekly wrap, we'll have a quick insight into the Ukrainian situation. I'm sure everybody's up to date with it at the moment. It really has been top of news, top of discussions, publications, and really first and foremost for everyone around the world because it is such a significant situation at the moment. We're in the 8th day since Russia announced their special military operation and invaded into Ukrainian territory. The troop build-up as well as the advance continues on. But really the Ukrainian defense has been incredibly resolute. It's been inspiring reading about the stories, about the speeches, is, and I'm sure many people are familiar with it. And thus, so far, Kiev, the capital city, has not been captured yet. And of course, there has been a globally coordinated effort from many countries, many organizations, many companies around the world to really condemn what's been playing out in Ukraine. But also there's been coordinated economic sanctions that have really flowed through and have started to cripple the Russian economy as well. And so thinking about those economic implications, of course, there are rippling effects across the global economy. Not only are they on the economic sanctions front, but there's effects from the supply chains. We all know about the effect that supply chains and supply chain bottlenecks, as well as the logistical issues that have played out over the past year, have had into inflation. But we're really seeing these exacerbated, particularly in the European region, as on the back of everything that's played out in Ukraine. First and foremost has been the energy discussion. We know that Russia is a major exporter both of oil and natural gas and is a significant energy exporter. It is a large part of their GDP, and we've seen oil prices surge past the $110 mark. It's the first time in over 8 years now, and it really has been quite significant. To give you a bit of an idea of the scale of Russia's energy exports, they're the world's third largest oil exporter, and they supply 1/3 of the European Union's gas. So it is globally significant. Nord Stream 2, which was the gas pipeline from Germany to Russia, of course, has been halted now as a result of everything that's been playing out. And Nord Stream 2 has actually announced that they have been laying off employees. What is interesting in terms of the current state of play is that there's been significant economic sanctions, wide-reaching. However, energy, by and large, has still been mostly carved out from these sanctions because of the potential ripple-through effects that it could have for the rest of the economy. But as things continue to rise, if they do continue to escalate, this is going to be an important thing to continue to watch on that front. In terms of the economic sanctions, there has been removal from many Russian entities from the SWIFT messaging system, which is a global bank messaging system. Many companies have been distancing themselves globally, notably including BP and Shell, but it goes for a range of organizations, even on the sporting front, and many others. The Russian ruble, as well as the MOEX Russian index, have tanked significantly. And of course, there has been talks about this $600 billion plus Russian war chest, which had Forex reserves as well as gold reserves, which have actually been isolated. And so as a result of that, they have been much more difficult to access. And so they haven't been able to prop up the ruble as well as some of their other broader macroeconomic picture. We've seen the Russian central bank raise interest rates as a way to combat this and to try and prop up the ruble and the economy. So the interest rates have risen from 9.5% to 20% as a way to try and attract foreign direct investment. But of course, there's uncertainties about really the long-lasting impacts that this could have on the Russian economy and many individuals in Russia as well. On the disrupted supply chains, it's worth noting that Ukraine has been noted as the breadbasket of Europe. So Russia and Ukraine together makes up around about 1/3 of the global wheat export. So it's absolutely massive. Ukraine produces wheat, barley, rye, and corn. Just to give you an insight into some of the different commodities that's produced. And we know that rising food prices and input costs can be further inflationary at a time when central banks around the world are trying to combat persistent inflation that has been much more persistent than was initially forecasted. It's worth noting as well, closer to home, that Australian floods, as we saw in southeast Queensland and now in New South Wales as well, have the ability to and have been impacting supply chains. And so, of course, that's only going to make it more difficult for agriculture supply chains around the world. Once again, thoughts are with anyone who has been affected. Some of the images in terms of the floods have been really difficult to watch. So thoughts are with anyone who has been affected in any way from those floods too. And so with all of that, we know that a lot of the narrative over these past 6 to 12 months has been surrounding inflation, which is more persistent than initially thought. But most importantly, what that means for central banks and how they can look to combat that. Jerome Powell, the Federal Reserve Chair, recently spoke ahead of the upcoming meeting, which is scheduled for March 15th and 16th. And we know that the global macro picture adds additional uncertainty at this moment. Jerome Powell did speak about the fact that there is an extremely tight labour market, which is one of the forecasted conditions that they wanted to achieve, and of course, persistent price pressures. They still do believe that inflationary pressures will recede, but they do want to see price stability back into that 2 to 3% level in terms of persistent inflation. We do know, interestingly, that there's one more CPI print on March the 10th, which, of course, the Federal Reserve will be using as a bit of a lead and an insight into their decision in the coming days after that. But it does look like, and Jerome Powell was a lot more prescriptive in this discussion than he traditionally is in some of his speeches, that he believes it looks likely that it will be 25 basis points. Of course, there's been a lot of uncertainties about whether we'd see a 50 basis point hike, whether we'd get some more insights about balance sheet unwinding, but a lot of the thoughts now are that it's looking like a 25 basis point for this rise, but of course, there is likely to be further rate rises moving forward into 2022. And so as a bit of an insight into that, we know that the next FOMC meeting is March 15th and 16th. This was the dot plots that we were provided at the previous Federal Reserve meeting. And of course, we got a bit of an insight into the potential trajectory of the rate rises. There's still a question about where is the neutral rate? Where does that sit? But the markets has been pricing in as much as 4, 5, 6, 7 rate hikes, of course, in 2022. Of course, as we did talk about, it does look like that the global uncertainty is probably going to mean that central banks have a little bit more optionality in terms of timing, and so they'll have a bit more of a wait and see approach. But it does look likely that we're going to get that first rate rise in March and then potentially more inconsequent Federal Reserve meetings from there. It really is a difficult time, not only on markets, but most importantly around the world. We've seen the humanitarian effect on, of course, everything that's playing out in Ukraine. There's been significant civilians that have been fleeing into neighboring territories. And it is a difficult period. So thoughts really are with anyone who's affected, but most importantly, really hoping for a resolution that's as fast as possible and really is as safe as possible and preserves as much human life as we can. It's going to be an interesting upcoming period. We've got this Federal Reserve coming up ahead. We haven't done one of these weekly wrap videos on the channel in recent times, so let us know if you did enjoy this style of video. If you did, hit that like button. If you're new here, make sure you've subscribed. Turn your bell notifications on so you won't miss any of our daily episodes. Thank you so much for joining us. For now, stay well and happy investing.